125 cases over 4 years, and $6 billion. This isn't war damage from some country. The US SEC, the Securities and Exchange Commission, poured out this many enforcement actions and this much in fines on the crypto industry between 2021 and 2024. They sued Coinbase, they sued Binance, they sued Ripple. Back then, the industry lived with one constant fear. We might be next. That fear was everyday life. But in March 2026, everything flipped. The SEC, the Securities and Exchange Commission, and the CFTC, the Commodity Futures Trading Commission, jointly released a 68-page official interpretive guidance. It all boils down to one sentence. Bitcoin, Ethereum, Solana, Ripple, Dogecoin, and others. 16 major digital assets are not securities. SEC Chair Paul Atkins said it himself at the event. We are no longer the commission of securities and everything else. He declared in his own words that over a decade of uncertainty is over. If we read this news today as simply, oh, regulations got relaxed, and move on, we are only seeing half the picture. Why did this decision happen? And what flows of money? Does it actually change? Let's break that structure apart, piece by piece. Now, you might be thinking, was Bitcoin never a security to begin with? Why is this such a big deal? You are right. Bitcoin was never designed to function like a security. The problem is that US regulators applied a legal standard called the Howey test, a precedent created back in 1946. In simple terms, it says this: if you invest money expecting profits based on someone else's managerial efforts, that structure is a security. It was originally created to evaluate an Orange Grove investment scam, and 80 years later, they applied it verbatim to digital assets. It's like trying to enforce speeding laws for cars, using traffic regulations written for horse-drawn carriages. When the standard doesn't fit, interpretations diverge. And when interpretations diverge, the market had to operate, never knowing when the next crackdown would hit. The result showed up in the numbers. As Chair Atkins himself acknowledged, regulatory uncertainty pushed the digital asset industry and its capital outside the US. Exchanges relocated their headquarters to Singapore or Dubai, and developers moved to Europe. It was not that there were no rules. It was that the rules were unpredictable. That is what caused the exodus. This joint guidance from the SEC and CFTC cuts through that structure. Assets whose value is determined, not by someone else's managerial efforts, but by network participants and supply-demand dynamics. Those assets will sit outside securities regulation. That is the declaration. The legal fog that choked the industry for a decade has begun to lift with these 68 pages. What's fascinating is this: on the very same day that announcement dropped, someone responded, not with words, but with action. March 17th, the same day as the SEC announcement, Morgan Stanley filed an S1 amendment with the SEC for its own spot Bitcoin ETF called MSBT, Target Exchange, NYSE ARCA. The timing is too precise to call it coincidence. What matters here is not that Morgan Stanley simply wants to create yet another ETF. Since 2024, they have already been allowing their advisors to recommend Bitcoin ETFs like BlackRock's IBIT and Fidelity's FBTC to clients. So why launch their own now? Fees. When recommending someone else's ETF, you only take a slice of the sales commission. But if you issue it yourself, you keep the entire management fee. BlackRock's IBIT charges 0.25% annually. Morgan Stanley manages $1.9 trillion in assets if they push their own product. Through a network of 15,000 advisors, you can imagine how different that structure becomes. Think of it this way. Until now, Morgan Stanley was a convenience store, stocking someone else's brand of bottled water. Now they are creating their own brand and filling every shelf with it. They already have the distribution network. They already have the customers. The custody structure is already in place. Physical Bitcoin is held by Coinbase in cold wallets. Cash management and administration handled by BNY Mellon, the dual custody structure that the SEC prefers most. They have already purchased 50,000 seed shares, roughly $1 million worth. This is not exploration. It is a signal they are on the verge of actual launch. The first major US bank to issue its own Bitcoin ETF. That title matters because after Morgan Stanley comes JP Morgan, and after JP Morgan comes Goldman Sachs, each asking themselves the same question. But let us pause here and look at this with a cool head. If you're expecting this news to push Bitcoin's price up right now, that is a different story. In reality, Bitcoin's price right now, despite all this positive news, is hovering below $70,000. That is more than 40% below the all-time high of $126,000, hit back in October 2025, on the day of the SEC announcement, and on the day Morgan Stanley filed. The market barely moved. Why? What is moving the market right now is not regulatory news. It is macroeconomic variables. Oil prices have surged over 40% in a short period due to escalating tensions with Iran. Fears of reigniting inflation are raising their head again. Parts of the market have even started pricing in the possibility that the Fed could raise interest rates. In this environment, no good news can easily lift short-term prices. When the fear index is high, even good news gets buried in the noise. But here is where we need to shift our time horizon. The fact that the short-term market is not reacting, and the fact that the underlying structure is changing. Those are two completely different stories. When spot Bitcoin ETFs were first approved, back in January 2024, within 16 months, cumulative net inflows exceeded $56 billion, and roughly 7% of all circulating Bitcoin moved into those ETFs. A significant portion of that capital did not follow after prices rose. It could only move after the legal structure became clear. That is the money that moved. This SEC guidance opens a door one level higher than that. According to JP Morgan, crypto markets attracted $130 billion in flows in 2025 alone. And for 2026, they expect even more. The main actors' pension funds and sovereign wealth funds, these institutions, bound by the operating mandates, could not invest if even 1% of legal uncertainty remained. Full stop. Until now. But once the mechanical fear selling subsides and the fog of macro variables clears, in that next phase, the market's question changes from should we buy Bitcoin to how much of our portfolio should be allocated to Bitcoin? When the entities asking that question are not individual investors, but pension funds and sovereign wealth funds, the unit changes entirely. The SEC's declaration did not change today's price. It changed the range of capital that can move tomorrow. Let me wrap this up. For the past decade, what blocked Bitcoin's institutional entry was not a technology problem. One legal precedent from 1946 created the legal fog. That fog pushed capital overseas, and exchanges and developers had to build their ecosystems outside the United States. On March 17, 2026, the SEC and CFTC cleared that fog with 68 pages. And on the same day, Morgan Stanley, managing $1.9 trillion, responded not with words, but with a filing. It is okay if prices do not rise today. What is moving right now is not price, it is structure. Institutions that could not touch Bitcoin If even 1% of legal uncertainty remained, pension funds and sovereign wealth funds can now, for the first time, add Bitcoin to their list of investable assets. For that capital to actually move will take time, but the direction has already changed. Regulation did not give Bitcoin permission. Bitcoin changed the direction of regulation. Watch it with a cold eye. Hold it for the long term. Today's structural shift is a far more important signal than tomorrow's price. This has been Owl Bitcoin. If you enjoyed the video, please like, and subscribing is a huge encouragement to keep making content. Thank you so much for watching all the way to the end.